Okay, so let's look at some other part of the note. Future operating losses. So should there be a provision for future operating losses? Right? Should there be a provision? Now, there shouldn't be a provision. No provision should be made for future operating losses because there are no liabilities. Yeah, because they arise in the future and therefore do not meet the criterion of the liability. So there's no point making a provision for future operating losses. Doesn't make any sense. Now, the next thing to look at is onerous contract. Now, onerous contract, yeah. What's an onerous contract? An onerous contract is a contract in which the unavoidable cost of meeting an obligation under a contract exceeds the economic value, so the economic benefit to be derived from to be derived, especially to be received under it. So we are saying that the unavoidable cost in a contract, if the unavoidable cost is greater than the economic benefit, then it is an onerous contract. A typical example is you lease the property and after a while you notice that the expected benefit from that property, maybe you want to use the property as a warehouse, you notice that the expected benefit from the property as a warehouse as does not even meet your expectation, such that the cost of renting the warehouse exceeds the benefit you are going to generate from revenue or from a profit. Then we are saying that is an onerous contract because the unavoidable cost. Now we are assuming that it's difficult for you to cancel the contract, and you can't just cancel the contract because there is either a penalty for canceling or you can't even cancel the contract at all. Then it is onerous because the unavoidable cost, that is the cost you must incur to either cancel or continue to fulfill your obligation, is greater than the benefit you expect from such contract. Onerous lease. An onerous lease is an onerous contract, that is one where the unavailable costs under the lease exceed the economic benefit expected to be gained from it. Now, please take note. Provisions, right? A provision for the net cost. So provision for the net cost, right, should be recognized as an expense in the income statement in the period when the lease become onerous. So we are saying that whenever the unavoidable cost exceeds the economic benefit, then you have to make a provision for the net cost, right? In subsequent period, the provision should be increased by the unwinding of discount recognized as finance charge and reduced by the lease payments made. Now, what are the unavoidable costs in this case? Now, I said it earlier. I said unavoidable cost is the cost of fulfilling the contract. That is the cost of that to continue fulfilling the contract. Cost of fulfilling the contract. Fulfilling the contract. The lower unavailable cost. The lower of cost of fulfilling the contract and penalty for default. That is the penalty for failure to fulfill the contract. Penalty from failure to fulfill. So let's take note. Cost of fulfilling the contract, the lower of cost of fulfilling the contract, and penalty from failure to fulfill the contract. The lower of these two is what is known as unavoidable cost. Let's look at illustration 6 to illustrate this. Now, you have a contract. You have a contract to buy 300 meters of silk from China Co. each month for 9 naira per meter. From each meter silk, you make one silk shirt. Straightforward. You also incur labor and other direct costs of 8 per 9 per meter for the material. Direct costs, direct labor and direct variable costs, 8 naira per shirt. Usually you can sell this shirt for 20 naira, but in late July the market price falls to 14. You are considering ceasing production since you think that the market may not improve. If you decide to cancel the SIG purchase contract without 2 month notice, you must pay a cancellation of 1,002 for each of the next month. Required. Is there a present obligation at the period end, 31 July 2088? What will appear in respect of the contract in your financial statement for the period ending 31 July 2088? So, yeah, it's as simple as that. Just the two stuff there. Now, the first question is there a present obligation? Don't forget, present obligation arises when it is an onerous contract. And there can only be an onerous contract when the unavoidable cost exceeds the economic benefit to be derived from the contract. So first, let's start with what is the benefit. So the first part, okay, let's start with the first part. The A is asking that, is there a present obligation? Yes, there is a present obligation because, yeah, there's a present obligation because number one, you must fulfill the contract, otherwise you have to pay 2 month penalty. You have to pay a 2 month cancellation fee if you do not give a 2 month notice. So he's already thinking of ceasing operation, so he has to pay at the least. He has to pay the 2 month notice. Then we also need to determine if it is actually an onerous contract. If it is an onerous contract, that's another point why it should be. So let's quickly see if we can determine if it is an onerous contract. Now, don't forget, an onerous contract is, so it is onerous contract equals to the cost of when the unavoidable cost exceed, when the unavoidable cost exceed the economic benefit. Let's not forget that. So let's start with unavoidable costs. Unavoidable cost is the lower of cost of fulfilling and is the lower of the cost of fulfilling and penalty for failure to fulfill. So now let's start with what's the cost of fulfilling. The cost of fulfilling is actually the amount we pay as rent, right? Or sorry, did I say rent? The amount we pay for buying the 300 meters. So 300 meters, right, of SIG times 9 naira per meter. That will give us 2007, right? Let's see that. You have a contract to buy 300 meters, yeah? 2007. So it means that each month, yeah, 2007, this is the cost of fulfilling the contract, right? Let's look at the second one. Failure penalty for failure. For failure to fulfill. Now, what's the penalty for failure to fulfill? You're going to be paying 2 months rent. So, sorry, 2 months penalty for cancellation if you don't give a 2 month notice. In this case, you're not giving a 2 month notice. So, I'm just going to look at how much are you going to pay? 1,000 to 1,002 per year. Now, 1,002 per year, which means that, sorry, per month, which means that for 2 months, I'll be paying 2,400. Now, the lower of these two is the penalty to fulfill. So therefore, our unavoidable cost equals 2,400. So 2,400 is our unavoidable cost. Then we can now look at what is the economy benefit. So it's a step after, one step after the other. Economy benefit. So what is the economy benefit to be derived if the contract is fulfilled? Now, what is the revenue? The revenue, you are expected to sell it on normal day 20, but then prices has fallen, so 14 times. How many silk are you going to make? So we said we are going to buy 300 meters. From each meter of silk to make one silk shirt, right? You have a contract to buy 300 meters. You now say from each, so from 1 meter of silk, you can make one shirt. So it means that you are going to be making 300 shirts. 1 meter for one shirt, and you're buying 300, so that's 300 shirts. So times 300 shirts. That will give us 14 times 300. That will give us 4,200. Now, what are the costs you are going to incur? Material, we add that up, which is the 2,700. Then we're told that there's a direct cost, labor and direct costs, which is 8 naira per shirt. That will be 8 times 300. 8 times 300. So 8 times 300 should give us 2,004, I guess. 8 times 300, 2,004. So 2004 plus 2007, that should give us 5,001. So the economic benefit that you'll be deriving from this is a loss of 900. Now, this is an onerous contract, right? Because the unavoidable costs exceed the economic benefit. Unavoidable costs 2004 exceeds the 900 that you're going to be paying. So it is an it is an onerous contract. So please take note. This is an onerous contract because the unavoidable cost exceed. This is the unavoidable cost exceeds the cost, the benefit of fulfilling. Benefit of fulfilling. So it is an onerous contract. What we are paying respect. So this is another point for the reason why there's an obligation up there. Now the question is what will appear in respect of the contract in your financial statement for the period ending 31 July 20x8. So what were we told to make it? They said the provision of this net cost should be recognized as an expense. Now, the provision for this net cost, the net cost in this case is a loss you are making. That is the net cost. So our provision to be made is 900. So it means that I debit my provision, sorry, I debit my P and L and I credit my provision. Simple as A, B, C. So that's that about onerous contract. Onerous contract is just you having an understanding and remembering that an onerous contract exists when the unavoidable cost exceeds the benefits, the economic benefits derived from fulfilling the contract. Then your unavoidable cost is simple, the lower of cost of fulfilling and penalty for failure to fulfill. Once you get that, then you compare it, then you look at what it is, and that is what you have there. Okay. So yeah, this takes me straight to the next item we're going to be looking at, which is restructuring. Now, restructuring is another bit that I would actually like us to just look at because restructuring is a bit, I won't say technical, but then you need to be a bit careful when you talk about restructuring. Because in restructuring, you have things like, and you must have some criteria in addition to the first three criteria for provision. For example, you must have a detailed formal plan. Let's just go to the note and we can see what that is. Restructuring is a program that is planned and controlled by management and materially changes either the scope. So for you to say there's a restructuring, one of these two must exist. Is either the scope, right, of the business undertaken by an entity has changed, or the manner in which the business is conducted has changed. So take note of that. Restructuring include sales and termination of a line of business, closure of a business location, changes in management structure, fundamental organization, reorganization of company. These four are of types, example of restructuring. Now, let's quickly have this important note. A mere management decision is not sufficient for you to make a provision. Now, what do we mean? That management have decided that we are going to have a restructuring does not mean you are going to make a provision for restructuring. Now, what triggers the provision for restructuring? Management decision may sometimes trigger off recognition. Now, but only if earlier events such as negotiation with employee representative and other interested parties have been concluded, subject only to management approval. Now, let me just quickly explain something. For a restructuring, for a provision should be made on restructuring, number one, there must be two things: detailed formal plan, and number two, there must have been communicated to those affected. To those affected. Now, if these two does not happen, then no provision should be made. Detailed formal plan, documented detailed formal plan. Communication, whether you must have informed those that will be affected by the restructuring. Then at that point, it can trigger. These are the two things that actually trigger the present liability. Now, we are not saying that in cases where there have been communication with those affected in the first place, but the communication is subject to the approval of management, then if management approve at that point, then it becomes an obligation. But if there was no communication in the first place with those that are affected by the restructuring, and management just decide that, oh, we are going to have a restructuring, then we are saying that it doesn't trigger a liability until those that are affected are communicated to. Okay. The provision for restructuring is recognized only when the entity has a constructive obligation to restructure. We've already said that. There's a detailed formal plan and there's a valid expectation in those affected that it will carry out the restructuring. Okay, let's just do that. Such an obligation only arises where an entity has a detailed formal plan for restructuring. But this is not enough because my man may change it, man. Has raised a valid expectation. And how do you raise a valid expectation? By communicating to them. In those affected, that it will carry out the restructuring by starting to implement the plan or announcing the main features of those affected by it, since management is now very unlikely to change its mind. It should therefore include costs. Now, your restructuring costs or your restructuring provision should include the following, such as redundancy and write down property, plant, and equipment. The provision should include direct expenditure arising from restructuring, one, but it must exclude as costs associated with ongoing activities. For example, let's say training. Restructuring does not include such costs as retraining or relocating continuous staff. No. Marketing. No. Investment in new system and distribution network. No. These three are not to be included as part of a restructuring provision. So don't forget, it should include direct expenditure. Now, illustration 8 for us to look at what a restructuring is. So on 12 December 2020, the board of the entity of an entity decided to close down a division required. Assuming no step were taken to implement the decision, assuming no step was taken to implement the decision, so assuming no step were taken to implement the decision, and the decision was not communicated to any of those affected in the by the balance sheet date of 31 December 2020, explain the appropriate treatment. Now, this is very simple. We are saying that, oh, there's a plan, but then nothing is done. No communication. Even the plan is not well documented. Then we are saying that no provisions for restructuring, no provision for restructuring, no provision for restructuring should be made because no valid expectation created yet. So let's take note of that. Very, very important. Now, the second one is explain the appropriate accounting treatment for the closure if a detailed plan had been agreed by the board, one, on 20 December 2020, and letter sent to notify customer. The staff of the division has received redundancy notice. So for B, then provisions for restructuring should be made because one, there is a detailed plan, right? We're told that there's a detailed plan rather. Yeah, detailed plan has been agreed by the board. Then two, there's a valid expectation created because this has been communicated. So simple. Those are the two criteria, or those are the two very, very simple examples that you can just use to understand what should be recognized for a restructuring. Okay. Let's look at illustration 9. On 14 June 2005, a decision was made by the board of an entity to close a division. On 28 June 2005, a detailed plan for closing down the division was agreed by the board. Redundant notices were sent out to staff of those affected division of the affected division. Division was closed September 2005. Should a provision be made as at 30th June 2005 for the cost of closing down? Yes, a provision should be made mainly because there was a detailed plan before the end of the period. One and two, right? There was a detailed plan before the end of the period, and two, there was a communication. So they've created a valid expectation to those that were affected. So that's that about the whole restructuring bit. We just have to look at the next line item, which is what is a debit entry for a provision. Okay. Now, or let me rephrase the question. Is it every time that you debit profit and loss? Anytime you are creating a provision for anytime you are creating a provision for restructuring, do you have to debit your P&L? Now the answer is no. In some cases, for your provisions, in some cases, there are two items that can be debited. Number one, you can debit your PPE, or should I say PPE? No, let me not say PPE, let me just use assets. Or you debit your P or L. Now, in what instances do you debit your asset? Now, you debit your assets if the provision is, for example, how do I put it now? Now, if the provision is as a result of an asset, take for example, you have an oil rig, and the oil rig at the end of the day, or let me not use oil rig, you rented an apartment, an office space, and after renting this office space, you decided to have some what do we call it now? Decided to have some leasehold improvement on the building. For example, is an open plan space, but then you have a demarcation for each offices, like you yeah, like for each offices you have a furniture and fittings to create offices and the like. Now the question is, the landlord has told you that by the time you're leaving the space, you are expected to you're expected to how do I put it now? You're expected to you're expected to ensure that that space is the same way you met it. Now, it means that the landlord is saying that I don't want to see anything, whether what you use in demarcating the offices or whatsoever structure, the fittings you've put in, I don't want to see it. I want to see this place the way I gave it to you. Now, you can see that you are going to be making a provision for the end of your tenure of your rental agreement to clear or to dismantle the whole of those the whole of the fittings you've actually put in on the open floor or the open space. Now, for such, because it's arising as a result of the lease and the fittings, then you have to create a provision that is going to be an asset rather than putting that's going to be an asset that you now have to spread over the lease term or the rental term or the contractual term, rather than putting the whole of that provision in your P&L. So that's a typical example of when you can have it as an asset. Every other type of provision should naturally go to your profit or loss. Now let's see what this place is saying. Saying that when a provision is recognized, the debit entry for provision is not always an expense all the time. Sometimes the provision will form part of the cost of an asset. So it means that you debit your asset, you add it to the value of the asset. Examples: obligation of environmental cleanup when a new mine is opened or an offshore oil rig is installed. So please don't forget that. Use of a provision. Provision should only be used for the purpose of for which they were originally recognized. They should be reviewed at each balance sheet date and adjusted to reflect the current best practice. If it is not, if it is no longer probable, then an outflow of resources will be required to settle the obligation. The provision should be what? Should be reversed. So we are saying that provision should is an estimate, so it can always change based on the update or based on the updated information you have pertaining to the estimate. Now, in as much as the estimate is still valid and you are sure that you are still going to be made and the three criteria are still met, then you don't have to reverse it. But as soon as the provision criteria has been as they are no longer met or it has been fulfilled or the time has elapsed, then you have to what? Reverse the provision that is left. Right. We've talked about contingent liability, but then I'm just going to look at the bits that we've not talked about. An entity should not recognize the contingent liability. The contingent liability is disclosed unless the possibility of outflow of economic benefit is remote. So if it is far, if the possibility is far, then you don't have to disclose. You don't have to do anything. But if it is near, let's say in 5 years' time, in 3 years' time, then you have to disclose that. Disclosure for each class of contingent liability, the nature of the contingent liability, the estimate of the financial effect, if it is possible. If it is not possible, it's not compulsory, you have to do that. Because everything in your financial statement must be reliable. So if you cannot estimate the value reliably, you don't have to bother. The allocation of uncertainty related to the amount what must be fulfilled before what must be fulfilled to trigger this cost. And lastly, the possibility of any reimbursement. Is there going to be any reimbursement? The other thing I did not remember to talk about when we're looking at provision is that please take note. Reimbursement of a provision should not be used to not net off a provision. So we are saying that a reimbursement should be recognized as an asset, while provision should be recognized as a liability. Then contingent liability should not be recognized as a statement of financial position. Should be disclosed in note unless the possibility. We've said that. Then let's finally look at contingent assets. Then you look at one more example on the provision that leads to an asset rather than an expense. Okay. Contingent asset. A contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entity. Right? Now, possible assets. Possible assets. Recognition. An entity should recognize a contingent asset because should not recognize a contingent asset because it could result in recognition of profit prudency concepts that may never be realized. Contingent assets should not generally be recognized, but if the possibility of inflow of economic benefit is probable, they should be disclosed. So if it is probable, 51%, 60%, they should be disclosed. But if a gain is virtually certain, you are sure that 100% you are going to get it, then it falls within the definition of an asset and it should be what? Recognized as such, not as a contingent asset. So that's that about contingent asset, contingent liability, and provision. In summary, before I go to the last bit of question, right? In summary, let's take them one by one. Provisions. Provisions. Don't forget what guys provision is. There's a present liability right? Yeah, there's a present liability, probable, and we said that is the likelihood is probable, that is 51, at least 51% likelihood. That's just an example, upward. At least 51% likelihood. Then certainty of the amount can be estimated reliably. Estimated reliably. Now, for a contingent liability, it is just possible liability. You're saying that, oh, yeah, there's a present obligation, but the liability is just possible, right? Then a contingent asset, you're saying a possible asset. So, in summary, this is what IS 37 is all about. Let me look at this last question on decommissioning and other environmental costs. The other time I was talking about what is it all the time that you debit expenses? No. Now, this is an example of when you debit a liability, decommissioning costs and environmental costs. Now, another word for decommissioning costs can be like dilapidation costs. Yeah, those are typical example of that. Decommissioning costs, dilapidation, environmental cleanup, restoring costs. So let me take that again. Decommissioning costs, dilapidation costs, restoring costs, restoring costs, right? Environmental cleanup. So these are the things that can actually lead to an asset being to an asset that can actually lead to a provision, or these are the things that leads to the debit of a provision to be an asset instead of an expense. So let's look at a provision will be made for future environmental costs if there is either a legal or constructive obligation to carry out the work. This will be discounted at the present value of the pre-tax market rate. This provision should only be recognized from the date in which the obligating event occurs. Illustration 10 and 11. An entity is about to begin to operate a coal mine. At the end of the reporting period, the mine shaft have been prepared and all necessary equipment has been constructed and is in place. But no coal has yet been extracted. Take note of that. But no coal has yet been extracted. Under local law, the entity is obliged to rectify all damage on the site once the mining operation has been completed. Once the mining operation has been completed. That means you have to restore it when you've completed all your mining operation. That is expected to be several years from now. Now, management estimates that 20% of the eventual cost of performing this work relate to removing the equipment and various buildings, and the remaining 80% will relate to restoring the damage caused by the actual extraction of the coal. Should a provision be recognized for the cost of restoring the damage? Now, this question has only asked us, illustration 10, should a provision be recognized for the cost of restoring the damage? Should a provision be made? Now, the question is, let's go back. What will trigger What will trigger this provision is the first question we should ask. Is it a legal or a constructive obligation? Now, what is the legal one in this case, or the constructive? They said the mine shaft has been prepared. They've prepared the mine shaft. It is already installed. That's been constructed and is in place, but no core has yet been extracted. So take note of that. They have not started extraction. Under local law, the entity is obliged to rectify all damage to the site once the mining operation has been completed. Take note of that. All damage to the site once the mining operation has been completed. Now, the question is, what are you restoring? You are only going to restore a damage. They said, should a provision be recognized for the cost of restoring the damage? Right? Now, I'll go back to under the local law, the entity is obliged to rectify the damage on the site once the mining operation has been conducted. Management estimate that 20% of the eventual cost of performing the work relate to removing the equipment of various buildings, and the remaining 80% will relate to restoring the damage. So the damage will be restored, right, based on the actual extraction of coal. It means that the obligation comes only as a result of extraction of the coal. Now I'm talking about the obligation for restoring the damages. We're told here that this relates to 80% relates to restoring the damage caused by the actual extraction of the coal, and this company has not extracted coal, so it means that no provision should be made for restoration of damage caused by actual extraction of coal. That's it. Nothing. No provision. Why? Because the extraction has not started. Now, if there was just should a provision be made? Yes, there will be a provision. What is the only provision that should be made at this point? Because they have actually done the construction, right? They've set up all the man shaft and everything. Then there should be a provision for what? For removing those equipment, which is the 20% that was stated there. But the question did not ask us about that. The question only asks for the restoration of the damage, which there hasn't been any damage because there's no extraction of mine yet. Then I go to question illustration 11. Now, a company has constructed an oil rig which became operational on 1 January 2013. The company has contracted to remove the oil rig and all associated information and to restore the site to repair any environmental damage on the site on completion of the drilling activity. This is estimated to be at a cost of 8 million in 10 years. That is a future cost. The pre-tax rate, don't forget, we said we should be discounted based on pre-tax rate, and we already have a future value. We have to discount to present. The pre-tax rate that reflects the current market assessment of the time value of money and the risk specific to the liabilities 10% required. Calculate the amount of provision on the initial recognition, and two, show the effect of the unwinding of the discount, interest expense, then calculate the depreciation on the removal of the cost. Very simple. The first one, we need to first get what is the present value. That is the amount you will spend, the liability in 10 years' time is 8 million, but that is not the actual liability. That is not the present value of the liability. We have to discount from future to present value. And don't forget, future value is equals to present value times 1 plus r raised to power minus n. Future value is 8 million, right? What is our present value? Our present value is what we are looking for, which is equals to sorry, present value one plus what is our discount rate? We're told that our discount rate specific to this is 10%. 1 plus 10% raised to power raised to power. This should be n and not minus n. Raised to power n. What is n? The number of years, 100. So let me just do this. This is number of years. This is present value. This is R is discount. R is discount rate. And this is the future value. Okay, so I have 8 million naira is equals to present value 1.1 raised to power 10. So my present value is equals 8 million times 1.1 raised to power minus 10. So what is this going to give us? 8 million times 1.1 raised to minus 10. That gives us 3084346. Let me just recheck that to be sure that I'm correct. 8 million times 1.1, yeah, raised to 1.1 raised to power minus 10. Yeah, so yeah, that's very correct. So this is the present value and this is our provision. All I need to do is debit now this is an oil rig that we need to restore. So debit my decommissioning cost. My decommissioning cost. This is my decommissioning cost and credit my provision for decommissioning liability. Decommissioning liability. So debit my decommissioning cost and credit my provision for decommissioning liability. So we can call this decommissioning costs assets. So take note of that.